What the administration would do is something, a tariff approach, maybe like a carrot and stick approach to try to get more of these NATO members to hit 2%. But we should note, these are just ideas within a campaign, and nothing has changed the U.S. force posture with NATO at the moment.
I got to be honest, Anne-Marie, before I went to sleep last night, I saw that ABC story saying that Russia's plans and their threat involve nuclear weapons in space, and then I prompted to not be able to sleep last night. What do we actually know about this?
Well, this caused a lot of confusion because you had a top GOP lawmaker coming out yesterday and saying that the president should declassify some of this information. What we do know is that Jake Sullivan, the president's national security advisor, will be meeting with top Republican and Democratic lawmakers, the Gang of Eight as they're known, in Washington, D.C. today to discuss this intelligence. And what we do know is that Russia is discussing the possibility of basing a nuclear weapon in space. Is it an immediate threat? No. So, Danny, you can go back to sleep. But what did cause a lot of concern was the fact that there was this time period where no one really knew what this Republican was talking about, and everyone was concerned that this was potentially imminent, but obviously potentially we'll get more details as he will be briefing those lawmakers today.
I know I probably still won't be able to sleep, but thank you for trying anyway. Anne-Marie Horder, thank you so much. Amy Wu Silverman of RBC is back with us. Amy, you write, talking about elections is so cringe. I agree with you, Amy, and I wish we could not talk about it, but we have to because we are in the middle of the swing of things when it comes to this campaign season. Do you adjust your portfolio? Do you buy hedges? Do you do anything to prepare for any potential outcome, or is that folly?
You know, if you look to history, the short answer is you really don't. You know, there tends to be some pop. You actually tend to get rallies into elections. But for the most part, elections are something that happen in cycles, but it doesn't really impact the market all that much. However, we do have to consider the tails. And, you know, it has been cringe, I think, for investors to talk about elections. Some have called it staring at the sun. It's just very unappealing. But given that we have this event ahead, I would say the left tail and the right tail right now are actually a Republican or a Democratic sweep. That's what they talk about on the tails. And then obviously the Supreme Court ruling is something that can, again, throw a mine into the field right now.
Here's something I didn't expect to see. You write that financials have been really well behaved during elections, an 88 positive hit ratio, 88% since 1992. Can that still play out, though, when you have simmering and sometimes boiling in the background concerns about regional banks, about NYCB? Is it the same this time?
So it's really interesting. First, I borrowed that statistic from our equity strategist, Lori Calvasina. So the only time since 1992, she notes, where financials didn't do well, go rally into election was the great financial crisis. Outside that, it's done well. And to me, it's actually a breadth argument, too, because if you're going to have a widening of breadth in the market, you're going to get that from financials. And three, I would say, while New York Bancorp was obviously down a lot, you actually did not see it in KRE volatility. So in fact, the put option prices for KRE remain near historic lows, even with what happened during NY Bancorp, which to me would argue that folks think the systemic risk is off the table.
The Hong Kong stock index, the HSI, Amy, it's down 50% from its 2021 peak. Even if I didn't believe in an economic recovery in China, even if I wasn't worried about some of the macro, the geopolitics, again, related to what we're talking about in this election, can I say I should be buying that because it's just sold off so much? It's got to mean revert at some point.
Yeah, so you know, look, every time I do my marketing trips to see clients, you know, globally, we talk about the China rebound. And if you'll actually remember, there was a time where the idea of a China rebound, of an Asia rebound was quite consensus. And then, you know, you kind of get into this, oh, it's uninvestable. What can I do about it? I would say right now the consensus is forming that perhaps we have seen a bottom. You really see that first in the options market. That tends to be the leading indicator because what people do initially is they just dip their toe in the water. You see that through FXI call buying, through ASHR, through KWEB, through these proxy ETFs, essentially saying, you know, I'm kind of worried that if it has bottomed, I really need to be able to jump into that pool. I want to be able to do that quickly. And so, again, you see that in the bullish option sentiment, which leads everything else.
I was going to say, you've seen some of those really big lottery ticket kind of bets in KWEB. That's, of course, the ETF tracking the China MSCI index. Volume spiked last week to the highest in a year. Does it make sense to go long those YOLO kind of China bets at this point? And can you not be actually long the cash market itself right now, Amy?
Yeah, I think it do make sense. And this goes back to the earlier comment I made about momentum in general, which is, if you think about what the options market is actually paying you to do, it's, in the case like in NVIDIA, for example, it's to sell that upside because it's so expensive. But if you actually backtest it, if you actually look at what happens, momentum begets more momentum. And there's obviously a gamma dynamic to that as well. So essentially, if you're worried about that right tail, which the market has repriced to be much more concerning to that left tail, that is what you do to get one toe in the water before you have to jump into the pool.
Amy, what I'm learning here is don't fight the big mo. You can't fight the momentum. Really great to catch up with you this morning. Amy Wu Silverman, thanks for your time. Let's get now some of the sector price action this morning and head over to Bloomberg's Abigail Doolittle. Abby.
So right now, Danny, we're looking at very interesting sector composition. We have the S&P 500 up about 0.3%, but most sectors are higher. In fact, we have a few sectors, about 5, that are higher by about 1%. Real estate up 2.1%. Its best day of the year on positive earnings reports. Utilities, materials, financials, energy, all up solidly. In fact, healthcare up pretty well too. But to the downside, you have those heavy weighted sectors, tech and communication services, both down. Communication services being dragged on by Google, down about 3% on reports that OpenAI may be creating a search feature. Let's take a look at another sector that is under pressure on the week, underperforming, and that is the S&P 500 retailing index, down 1.6%. The S&P 500 itself down about 0.3%, so really underperforming. This, of course, as we have those weak retailing numbers come out, but Lowe's, AutoZone, Ulta, those are some of the stocks in there. This index really not doing so well this week, Danny.
Abigail, appreciate it. Thank you very much. Now, coming up, we're going to look at the market-moving events that you need to be watching. That's up next in our Trading Diary. This is Bloomberg. Just about 30 minutes into your trading day. Small caps outperform, up by more than 1.33%. The Nasdaq down after those Cisco earnings disappoint with 4,000 job cuts. Your S&P little change, but we are back above 5,000. It is a Teflon market, maybe aided by some of the weaker retail sales data. Flip it up, look at bonds. Those are also getting a bid this morning. The bid started when we heard that there was a recession for both the UK and for Japan. You are looking at down about 4 basis points across the curve, belly of the curve, 10 10-year. That outperforms down 4.5. All right, time now for your trading diary. What you need to be watching this week. Fed Governor Chris Waller will be speaking at 1:15 Eastern. Then we're going to be hearing from Atlanta Fed President Raphael Bostic. That happens at 7. Then more earnings will be rolling out. DoorDash, Roku, and Coinbase all report after the close. Friday, San Francisco Fed President Mary Daly will be speaking. And then we're going to get U.S. PPI figures. Will that data, will the Fed speak, shake things up yet again in this resilient market? This was the countdown to the open. This is Bloomberg.
We're 30 minutes into the U.S. trading day, and it's Thursday, February 15th. And here are the top stories we're following. A weaker consumer. U.S. retail sales have dropped by the most in almost a year, with broad declines in spending. Yet bonds and stocks are still on the rise. Yields are back falling, back on the back of weaker economic data, with another feather in the cap toward rate cuts. And welcome to tax season. We're going to talk to the CEO of H&R Block about the challenges of the moment and how Americans are really faring on pocketbook issues. I'm Shonali Bassick in New York. Welcome to Bloomberg Markets. Let's get you a quick check on those markets. We are watching an S&P 500 back on the rise just a little bit, about 0.2%, but we have a NASDAQ 100 not feeling the same kind of love, down more than 0.2%. Alphabet, Nvidia among the decliners, along with Cisco in that NASDAQ 100. Yields, though, back on the decline. You have that bid back in the bond market after that weaker economic data and retail sales this morning, making the case for more rate cuts here. But listen, you do still have yields higher on the week at 454 on the week, and you're seeing only now about a 3 basis point decline after about 8 basis points yesterday, but we are certainly off the highs by more than 10 basis points on the year. Now we're going to talk more about the stock market because hedge funds are buying into some of the biggest names in tech in the fourth quarter. Amazon, Intel, Nvidia among some of the favorites revealed in yesterday's 13F filings. And for more, we're joined by Bloomberg's Christine Aquino. Christine, when you look at what the hedge funds have been doing, is it remarkable at all to see them follow the herd back into these big tech names?
Well, it's just interesting, Sonali, that's exactly right. As you say, they are following the herd. And even though there are so many worries about the valuations, particularly for some of these big tech companies, that clearly is no barrier for these hedge funds just piling on. And that really goes to show that, as far as the AI hype is concerned, there really isn't much hype. I mean, people are thinking that there's a lot more to it than meets the surface, and there's a lot of potential there for this sector to really grow. And that much is evident as well in a lot of the earnings results that we've seen, right? There's been a lot of mention of AI companies really wanting to leverage that technology. So definitely lots of room to grow for the sector, and therefore hedge funds piling into there.
Christine, are there any sectors or names that stuck out to you in particular that were bought in the fourth quarter? Of course, there's a lag, but we do like to follow how they're doing.
Yeah, exactly, Sonali. Actually, what really caught my eye was what they didn't buy, right? They're not buying consumer-focused stocks. They're not buying some of the popular pandemic-era trades that we saw a few years ago. I'm talking about a shift away from the likes of Nike and Pfizer. And so that really as well speaks to kind of how hedge funds are reading the macro tea leaves at the moment. Of course, we got that weak retail sales number earlier today, again, throwing some caution over the state of consumers, and we're seeing that as well in terms of the activity in hedge funds. They're really kind of moving away from that consumer-focused sector, perhaps as we navigate this new era of maybe potentially higher for longer interest rates.
Bloomberg's Christine Aquino, we thank you so much for keeping an eye on it all. Now let's talk markets now with Burns Kinney, portfolio manager at NFJ Investment Group. Burns, when you take a look at where investors are putting their new bets and you look at just how much love there has been, and not just technology but AI in particular, do you worry at all about valuations?
Well, the broader market valuation is certainly as rich as it's been. It's probably 22 times earnings for the S&P. It's more expensive than it's been about 75 to 80% of the time over the last 25 years. But that said, harkening back to the prior segment where we looked at a lot of the hedge fund dollars and the hot money has been going into the AI-fueled, the big mega cap tech bets. Just like I tell my teenagers, sometimes there's some wisdom in not following the crowd. We've been telling our clients as well that there's something to be said for zigging when others zag and being a bit contrarian.
What does that look like to you, Burns? Where do you buy if others are running away from certain sectors?
I think one of the places that's really interesting right now would be the healthcare sector. You've got an uncertain market. You do have rich valuations. And so healthcare kind of can play both roles as far as you can play defense if stocks are rich. You do have positive demographics. But likewise, you also have fantastic growth. That's the sector that you really get the best value for growth. And a lot of the healthcare names, they did lag a little bit last year. And so they represent great values today.
How do you feel about the financial sector? You've really seen the regional banks in particular take a beating. You've even seen some of the larger banks really start to waver on the heels of this kind of a higher for longer environment, consistently inverted yield curve that we're standing under. Do you start to pick at that sector?
It's something, you have to have a strong stomach, and I think likewise investors need to be selective. But there's also opportunities within financials, given the fact that we had in the fourth quarter last year a rally in the market as the market started to pricing the possibility of a soft landing. But the financials haven't necessarily kept up with that soft landing rally yet. And so it's a sector for which you have the lowest valuations. A lot of the big banks have passed some of the most strenuous stress tests ever. And there have been a lot of babies thrown out with the bathwater. If you look at the regional banks getting hammered over the last couple of weeks due to New York Community Bancorp, but a lot of what happened there was very firm specific. And so investors who are selective, there are definitely opportunities. We caution, you have to kind of dig into the numbers and maybe avoid those that might have excessive exposure to real estate or commercial real estate. But That said, there could be some great dividend payers and some solid names within financials.
How do you feel about the consumer these days? If you take a look at the data this morning and how surprising it was to most investors, many of the sectors that we focus on when we look at consumers were faring worse than expected. Do those weaknesses start to shine through when you're looking at corporate earnings in the current quarter?
Well, throughout the last couple of years, the consumer has been the workhorse of the U.S. economy. And the latest retail sales report, it was a little bit weaker than expected. It did come down from what was really a very strong December. And, we do caution investors from, focusing too much on one data point. And, really, if anything, what we saw from that, it kind of drove the focus back to the fact that perhaps the Fed will have the ability to cut interest rates at some point by mid-year. So that ends up being a positive. And finally, the case can be made that no one ever went broke betting on the U.S. consumers' willingness to spend beyond their means.
What does that mean, though? You already have consumers that have been borrowing on their credit cards at a record pace. We have seen credit card debt swell well past $1 trillion in the United States. At what point does that start to break?
Well, one case that can be made would be the fact that I think that a lot of what started to maybe eat into retail sales over the latest month has been the fact that consumers continue to face higher inflation numbers. And so if there's a catalyst that investors can look for that might actually spur spending, it would be the fact that inflation figures, they've been coming down. It's not in a straight line. But that said, they have been and should continue to pull back. And so as that's the case, then the consumers probably should feel a little bit more comfortable, and that should raise consumer confidence.
Hey, Burns, what is your base case here on how many rate cuts we actually get, and what ultimate impact would that have on the market?
Well, one of the things that I think is probably healthy for the markets are the fact that, late last year when the Fed pivoted and said we're going to start cutting rates, they suggested in their dot plots that they might cut rates 3 times this year. And of course, what drove the market rally in December was the market said, you said 3, how about 6 cuts? It's just the classic case of, you give a mouse a cookie, they're going to ask for a glass of milk and so on. And, I think what we've seen for the first 6 weeks of this year has been kind of a convergence between market expectations and what the Fed's already been saying. And so at this point, the markets have kind of gotten in line with what the Fed suggested of about 3 to 4 rate cuts this year, which probably makes a lot of sense with respect to that's what would bring us down to the I think the neutral rate with respect to the fact that those rate cuts don't necessarily have to happen because the economy is weakening, but rather because inflation has been pulling back. The Fed does have to be cautious of the inflation-adjusted rates, the real interest rate, becoming overly restricted. So for that reason alone, I think 3+ cuts probably makes a lot of sense this year.
Burns, stick with us. We'll be back with you in just a minute. We're first going to take a look at what's moving in the markets now with Bloomberg's Jess Menton. Jess, let's talk about Taiwan Semiconductor first here, because we are seeing quite a rally there.
We're seeing a record with what's happening with TSMC. And of course, when you think of this company, you obviously are going to associate it because it is a key chip supplier for NVIDIA, which everyone is eagerly awaiting NVIDIA's earnings report next Wednesday. So when you do see this, especially because Morgan Stanley actually upgraded when you are looking at its price target for NVIDIA. So right now it has a target on around $750. It was around $600 prior to that. So you are seeing a company like TSMC rallying on this, and especially just helping support overall when you're looking at Taiwan's stock market as well. So especially when you're thinking about NVIDIA, just overtook Alphabet in market value, also recently overtook when it came to Amazon. So when you're looking at the stocks with the chips makers this year alone, I mean, it's up already 9%. So after a stellar rally last year, so seeing chip makers really supported today.
Now, I want to talk about a flip side story here. Deere is now seeing its worst day intraday since November of last year. How are investors reacting to their current earnings?
Well, when it comes to Deere, this is such a big conglomerate when you think about what this means for the global economy. And a lot of when it comes to companies like this, when they are machinery makers here, it's been an issue when you are looking at crop supply. So especially when you're thinking about corn prices, obviously that's one of the most widely planted crops top here. It's actually trading at its lowest levels since 2020, so obviously that was the height of what was going on with COVID, but unfortunately, when you're looking at Deere, they did cut their annual profit growth because of what's happening with those kind of conditions, but when you're looking, obviously earnings are backward looking, so they beat on that, but when it comes to obviously those forward projections, that's where they missed. They cut the annual outlook, so that's why you're seeing those shares pressured today.
Let's talk about Shake Shack. We talked so much about the consumer. We started off talking about it today. It's one area you're not seeing weakness.
No, and this is a stock that's actually been up more than 60%. So I don't know about you, Shonali, but since we are in New York, it is kind of a place I tend to frequent often. But you did see when it came to margin, that's been the big key story as we know in the last couple of years because what inflation has meant, and especially after a lot of these different restaurants had to close because of the pandemic. But you're seeing those same-store sales growth surging. You also are seeing those up margin outlooks there. So that's something that, especially on a forward projection, when you are thinking about their earnings, if you are seeing those momentum when it comes to margin, that's obviously going to help support that stock price. We've clearly seen that over the past year. It also plans to open another 80 locations. That's another stock that's getting a boost this morning.
Jess Menton, we thank you so much for your time. Now coming up, we're going to talk about DoorDash, set to report earnings today as it looks to expand beyond restaurant delivery. Details on that up next. Stick with us. This is Bloomberg. DoorDash is reporting results after the bell today, and the company is expected to get a boost from investments outside of restaurants, including categories like groceries, alcohol, pet supplies, and flowers. Mandeep Singh of Bloomberg Intelligence has the details. We all know a lot of people were standing around DoorDashing those flowers last night, but all in all, when you look at the retail sales data this morning, after the fourth quarter, do you start to get a little concerned about how pinched the consumer is?
I mean, yes, there is definitely concern around consumer spending holding up. But look, the secular trend for all these marketplaces is the offline to online shift. And that's where, DoorDash continues to out-execute the other marketplaces, whether it's the likes of Uber on the delivery side, or even if you compare them to Lyft, even though, they are different marketplaces, just the sheer unit economics and, focus on execution, it's for DoorDash, it's far better. And for any marketplace, it's all about repeat rates and how you expand into other categories. DoorDash has done that successfully, going from online restaurant delivery to other categories, convenience and all kinds of delivery. And that last mile delivery market is huge. So that's where, it's hard to say that they're not executing.
They're still doubled in stock price just a year ago, or throughout the course of last year. So what does that mean for their valuation? How sensitive are they to any negative news?
I mean, look, they are sensitive to even inflation going up. So right now, inflation is going in their favor, and that's helping. But and regulation. I mean, you don't count that out. Like all these gig economy companies, at the end of the day, worker reclassification, it's going to be a big drag if that were to happen. I think with the scale that these companies have, it's hard to argue because, look, at the end of the day, Uber is generating about $60 billion in revenue for these gig economy workers. Same thing for DoorDash, and that's huge, in terms of what they are doing for the economy. So it's good to see them have scale and also show that they can be profitable.
Mandeep Singh, we'll look forward to those earnings after the bell. Thank you for your time. Now, let's welcome back Burns Kinney, Portfolio Manager at NFJ Investment Group. Burns, this has certainly been a week for the gig economy and the sharing economy. We've seen buybacks that we've never seen before, for example. Is this a sector that you would bet on?
It's not probably one of the top places we've been looking. I think I noted in the prior segment that healthcare looks interesting, and really even industrials would be a bit of a contrarian play in this market as well.
When you look at industrials too, and you see some of the softness that we've been seeing, we have PPI out tomorrow as well. Do you think that the economy is strong enough to withstand any pressures to the industrial sector?
In the near term, there could be some bumpiness, and in fact, if that's the case, then it would probably provide opportunities for investors to buy on the weakness. You might have some overall economic cyclical weakness, but that's one sector that actually has a lot of long-term secular tailwinds working in its favor, and that's the type of thing that can really drive things. If you're holding a stock for 3 to 5 years, you have factors such as, with geopolitical turmoil around the world, defense spending should have a floor. With the infrastructure bills that were passed a couple of years ago, people aren't talking about those as much anymore. But that said, a lot of that money is just now going out the door, and it's not expected to peak for another 2 or 3 years. And so you have that, as well as just, I think there's been an overall rebuilding the U.S. industrial manufacturing base. Industrial capacity utilization is at reasonable levels, and that suggests that at some point companies have to start investing in plant and equipment because stuff gets old and starts breaking. And you don't have really stretched valuations there.
What are some specific names you like within the sector?
I think that, one would be, I think that jumps out to me would be, a name like L3 Harris. It's a name that was formed by the merger between those two companies. And, you can get that at the low teens. It trades at about a 20% discount to its electronics and defense peers. They have an attractive dividend yield. And, really, because L3 and Harris were merged, that actually put it into the top 5 or 6 of the largest U.S. defense contractors. And of all businesses, that's one in which scale really plays a crucial role.
And what do you like specifically within healthcare, and why?
Within healthcare, I think that some of the things that jump out would be a name like an Agilent. You have that in med tech type names where it trades at a discount to its historical averages. Really the nice thing about the suppliers and the med techs, where they provide measuring instruments, it's the type of thing that's really the consummate pick and shovel play. Whereas we as investors don't have to be smart enough to know among the biotechs, among the drug companies, which drugs are going to succeed and which are going to fail. But that said, they're all going to have to use products from a name like Agilent.
Well, that was what I was going to ask you. One reason a lot of investors like healthcare is the development process, and in particularly the M&A outlook in that industry. How dangerous of a play could that be?
The M&A outlook is something for which, if anything, it creates opportunities. It's something for, a lot of investors like to make, top-down broad secular calls, but if you can actually make your money on, finding some names that are undervalued that can actually be, scoured out by other companies, then that really ends up being a testament just to good old-fashioned stock picking.
How do you feel that the risks to the market can be compounded over time? You know, you're looking at some sectors, financials, industrials, some beaten down names, where in a strong economy, of course, they are set to grow. But to what extent are you looking for macro data to weaken materially? What would scare you?
I think that it's the type of situation in which there's certainly a lot of uncertainty with respect to if we did have a second wave of inflation that might actually prevent the Fed from lowering interest rates. That could kind of put at risk that soft economic landing narrative that investors have embraced. So for that reason alone, I think that we are also telling investors that really if you're going to build a foundation for your portfolio, look for companies that have repeating, recurring earnings, predictable earnings. Look for companies that have clean balance sheets. They don't necessarily have to rely on banks for financing. And in that type of circumstance, probably one of the best ways to kind of ensure a portfolio would be to look for companies that are paying and really specifically raising dividends. I think that's something for which capital gains can be positive or negative, but that's a way that investors can, consistently and continually book a little bit of cash to cushion the downside.
Burns, I felt like a little earlier you had said that you expect maybe 3 rate cuts this year. What if you get none? If, say, investors do not see the materialization of rate cuts or even one or less than expected, how would that start to impact equity values?
I think that it would probably end up being, at least in the near term, it would be certainly a negative for equity values. It has a lot to do with, well, what is the reasoning for which you don't have any cuts? If it's because of the fact that inflation really flares up and you have sort of a second wave or an echo wave of inflation, then if you look at, basically, you sort of by tranche, if inflation continues to remain at 3, 4, or even go back up to 5%, then that should correlate with market PE multiples that would be lower than we are today. They should take a hit for that reason. On the flip side is if you don't see any rate cuts because the economy just continues to really churn along and show solid growth and the consumer stays strong, then at the very least that might drive corporate earnings enough to maybe offset that.
Burns McKinney, Portfolio Manager at NFJ Investment Group. We thank you so much for keeping an eye on these markets with us. Still ahead, we'll take a look at the companies making the most social buzz today. Social climbers up next. Stick with us. This is Bloomberg. Time now for Social Climbers, a look at the stocks making waves on social media this morning. First up, automaker Stellantis is warning of a tough year ahead thanks to softer vehicle prices. Here's the CEO on Bloomberg TV a little earlier.
We expect 2024 to be quite turbulent, indeed quite dynamic, but you know also that Stellantis is all about sports. It's all about racing. It is in our DNA to race. Which means we like turbulence. We like because it's a very competitive period in which you can demonstrate eventually that you are better than the other guys. So we like turbulence. It's an opportunity to show competitive edge for the company.
The Jeep maker is also planning for new buybacks and a higher dividend. Next, 13F filings reveal that NVIDIA holds a stake in SoundHound AI. The news is music to investors' ears as the shares in speech recognition companies soar. Finally, investors in Pernod Ricard are raising a glass to improving sales and forecasts. The Irish whiskey maker CEO points to higher demand in the United States, but warns that China drinkers remain cautious. You can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Coming up, U.S. retail sales down in the most in nearly a year as we approach tax season. We'll take the pulse of U.S. consumers with the H&R Block CEO. This is Bloomberg. January retail sales data declined the most in nearly a year, and it's raising questions about the durability of consumer spending. Joining us now is Bloomberg's Michael McKee. When you look at the data, Mike, what concerned you the most?
Well, the issue is why people spent less. Is it because they have less money or because the weather was terrible and they were stuck at home? There are some hints of both. The good news for the American people is, at least during the last 9 months, we are seeing average hourly earnings rise above inflation. Americans are finally getting ahead, and that should enable them to keep spending. You can see the gains that they've had have been going up, and so we'll see if that really continues to help. We also have seen strong job growth, and even stronger than anticipated, and all those additional people with jobs are going to be able to spend money. But as you mentioned, Sonali, they didn't in February, and that's going to be a worry going forward for the economy. Were they just taking a break because they couldn't get to the store, or were they taking a break because they don't have as much money as they used to? That's going to be one of the key questions. Now, our way too early award, because maybe the fact that Americans were making more money, goes to the Treasury Department, because we've seen tax receipts so far, which they report every day, higher than they were a year ago. The question is, does that continue? As you mentioned when we were off air, we are only just beginning the tax filing season, but you can see the early quarterly payments in January much stronger than they were in January a year ago. So let's see what happens, and let's hope that we continue to see continued income gains that help with the tax situation for the overall budget deficit.
Mike, really quickly here, we are going to talk a lot more about taxes in a second, but we did have critical data this week. We had retail sales, we had inflation data, and tomorrow we have producer prices. What are traders listening to the most?
Well, they're looking at inflation the most because that's what's driving the Fed these days. There were some questions about CPI, but it wasn't a particularly good look for the Fed that CPI went up. On the other hand, we had those disappointing retail sales. And if the economy is going to indeed slow, then that will suggest that inflation will slow as well. So the Fed is kind of in between right now, and that's why they're all talking about let's wait a little bit longer before we have to make a decision.
Michael McKee, thank you so much for keeping an eye on that data. And for more on the consumer, we are joined by Jeff Jones, H&R Block President and Chief Executive Officer. You did a study on how Americans are really faring, and what was really surprising about this study is it seems to conflict a lot with this strong economy, everything's okay narrative. What's going on?
Well, Sonali, great to see you. Before I answer, can I just acknowledge I'm from Kansas City, and we had a real tragedy yesterday in our city with the mass shooting. Our company's been embedded there since 1955. So I just wanted to acknowledge that I'm happy to be here with you today, but our hearts are really with everyone suffering in Kansas City right now.
Thank you for that.
So, we have such a unique perspective on the consumer for a couple reasons. Number one is, we sit with tens of millions of people a year to do their taxes. We also did a study last year called The Outlook on American Life, where we looked at over 1 billion anonymized data points from the tax returns. And so that view is a very on-the-ground view of the consumer. So inflation may be down, but in many categories, it's still very high. Wages may be up, but it's not keeping pace for the demands that people have. Jobs and unemployment are great, but we're seeing more and more millennials get a second job or a side hustle. And so I do think it's important that the macroeconomic data is one view. But when you start from the consumer up, we're definitely seeing a different perspective. Their wallets are strained, but their mindset is incredibly resilient, and we see that as well.
How much does this concern you about a barbell economy being created in this country?
For our consumers, we serve hardworking Americans, and so we don't really see necessarily a barbell economy emerging from that. What we see are people who need their refund and turn to us for expertise because every dollar matters. One other quick story, we announced last week on our quarterly earnings, we offer a short-term lending product in the holiday shopping season. It's called the Emerald Advance. Our loan volume this year was up 25%. So I think that also speaks to the short-term cash needs that consumers really have, again, maybe despite some of the macro trends.
Now, some of the macro trends, the reality is you did see spending start to subside in the beginning of this year, but what about after tax season? When people have less money because of the taxes they have to pay, how does that start to change the equation?
Well, keep in mind, most Americans get a refund. And so the average refund, might be a couple $1,000s depending on the year. And so they have this influx of cash, but for most Americans, it's already spent. So they're not thinking about necessarily planning a vacation or some elaborate purchase. They're paying their bills or catching up on debt. And so, again, for most Americans, a refund comes in, but it's already spent before it arrives.
So what does this mean for the uncertainties as well that they will be facing into the season? We've been talking to Mike McKee a little earlier. Yes, people are paying earlier, but a lot of people wait, as you say, till the middle of April. So how much uncertainty is there, especially with things like the child tax credit?
So think about the tax season, in our view, is officially 105 days from January 1 to April 15th. In every single day is a different consumer in the tax season. In the early part, it's consumers that need their refund, they file fast, they get their money. Later in the season, it tends to be people who are getting a refund and they owe money and they tend to wait. And so the child tax credit is likely to impact both of those consumers. And right now, we're waiting for it to come out of Senate. The IRS will then take a couple weeks to provide guidance on how to administer it. But we're used to that. Every year there are changes and last-minute things, so we're ready to serve our clients no matter when it comes.
Right. When you think about the issue of politics as it stands today, let alone the election, and any changes that there might be in taxes moving forward, how do you think about all of that uncertainty, and is there anything that you would take a stance on?
Well, for us, we have been through so many Republican or Democratic presidential changes in our history. What really drives change in our business is uncertainty with the consumers and their need for expert help. And so in a presidential election, depending on what happens with policy, we may see change that could create uncertainty. So that's what we pay attention to, but we can't predict what will happen. All we can do is be ready to respond and serve our clients.
Right. I mean, I think the natural thing to ask too is, with the deficit where it is, can taxes be expected to just go up meaningfully for all Americans here at this point?
Well, and again, I think that's a big question that will be on the table depending on which direction the election goes.
So let's talk a little more about the season as it stands as well. Big unknowns. You think about capital gains, you think about cryptocurrencies. How many questions are you getting around investing?
We're getting less and less this year. We certainly saw a spike around crypto maybe a year or two in helping educate people on the tax implications. But right now, I think people are very focused on income, refund or owing. Child tax credit is certainly a question on people's mind. It could be a real nice benefit for people if it gets approved and if it's retroactive for this season. Those are still questions. We think it will be. When the IRS released their first public data maybe a week ago, they showed that the industry tax filing volume was down about 19%, which simply means timing. This year, more people are waiting to file, and we think in large part that's waiting to get resolution on the child tax credit.
All in all, how do you think operations will be impacted at H&R Block through the rest of this year? What will be the biggest drivers?
Volume. The number of people that come in, the number of experts we have to match them. We anticipate this is a normal tax season, believe it or not. There's been a lot of unusual wins the last few years, and that means the industry grows 1%. And so again, we've been doing this since 1955. We know how to deal with the changes that come at the state or federal level, and we're ready to serve our clients.
Jeff Jones of H&R Block, we thank you for your time. Now let's get a quick check on the markets. Abby?
Well, Janelle, we right now have mixed markets. The S&P 500 off of its highs, up just slightly, up about 0.1%. It is the NASDAQ 100 that is lower, though. Not by a lot, but it's worth note that divergence is worth noting. Down about 0.3%. We have natural gas. It had earlier been up more than 1% on the cold weather, now up just modestly. And the Bloomberg Dollar Index down for a second day in a row. Let's check in on yields, because there was quite a reaction in yields earlier, dropping a bid for bonds on that weak retail sales sales number now off of those lows, but nonetheless down about 11 bips over the last 2 days. And there is a haven feel to it, Sonali. I think some of that has to do with some of the big tech selling that we're seeing, more specifically Alphabet. That stock is down more than 2%. It's down closer to 3% on a report that OpenAI may reportedly be developing a search feature. Microsoft, though, not higher on that report. So again, big tech is lower. And then take a look at Apple, down 1.2%. This, of course, of Berkshire Hathaway has started to trim that position. If we check in on the chart, because you know that I love technicals, this is a great example of why technicals work, because all this choppiness that we've had over the last several months, that likely represents some of that selling pressure from Berkshire Hathaway, one of the big whales. They don't want to sell in a straight line, otherwise it will reduce their profit. But net, this has taken Apple below its 200-day moving average. The RSI momentum is going to the downside, suggesting that selling may in fact be why Apple is down more than 5% on the year relative to the S&P 500 higher. We, of course, won't know that until May when the next round of 13Fs come out, but certainly something to keep an eye on, that weakness for Apple. As go Apple, as the market goes.
Bloomberg's Abigail Doolittle, we thank you for your time. Now, coming up next, we're going to be joined by Libby Cantrell, PIMCO, head of U.S. policy, to discuss how the Fed handles a presidential election year. Stick with us. That's for Wall Street Week, up next.
This is Wall Street Week. I'm David Weston. We have been doing a series of reports on Wall Street votes. That is to say, what difference the presidential election could make for Wall Street. And to help us in that effort, we welcome now back Libby Cantrell. She is PIMCO head of U.S. Public Policy. Libby, thanks so much for being here.
Thanks so much for having me.
So we don't know a lot about the election still. We think it may be Donald Trump against Joe Biden. Assuming for the moment that those are the candidates come November, what could it mean for Wall Street? And let's start with fiscal policy.
Yeah, so fiscal policy, and so the first big fiscal inflection point that either Joe Biden or Donald Trump would have to address in 2025, outside of the debt limit, because remember the debt limit's now raised until the beginning of 2025, will be the Trump tax cuts on the personal side. If you remember, David, when the Trump tax cuts were passed in 2017, they extended the personal side through 2025, and so those all expire at the end of 2025. So again, the big fiscal inflection point will be that. And that will honestly depend a lot, of course, on who's in the White House, but really importantly, what the composition of Congress is. The Senate right now controlled by Democrats, the House right now controlled by Republicans. We actually could see both chambers flip. Just because of the Senate map, you could see the Senate be controlled by Republicans, the House be controlled by Democrats. And that sort of means a muddled middle in some ways. Trump will, of course, want to extend all of those Trump tax cuts on the personal side. President Biden probably would want to do a bit partial, but again, it will really come down to Congress. If either has a clean sweep, then what we could assume is that all the Trump tax cuts on the personal side would be extended under a Trump Republican Congress. For Democrats, probably about part of them would be extended if Democratic Congress and President Biden's in the White House. So I think that the bottom line, though, for us as bond investors, is that both of them will likely extend at least some of those Trump tax cuts and probably be deficit financed. They probably will be paid for. That means that debt issuance will likely go up under either president.
Well, let's talk about that debt and deficit, because it's much talked about, not much is done about it. Is there much difference, do you think, between these two policies, sets of policies, Biden and Trump, when it comes to that? Because mainly when I talk about this, people say it's got to be entitlements you got to address. You've got to address Social Security, you got to address Medicare. I'm not sure that either one wants to address those issues.
That's exactly right, David. So the deficit, I think, is sort of the big loser here under either a Biden win or a Trump win for that very reason. Now, of course, you could increase revenues by increasing taxes. That's not usually very popular, though, and that's what something I think President Biden has talked about. But at the end of the day, if you look at sort of the fiscal trajectory of the United States, so much of the increase in the deficit and then our collective debt is because of entitlements. Of course, the country is aging. More folks are going on Social Security and Medicare. And as a result, if we don't do something in terms of reforming those benefits, not for current beneficiaries, but for folks who are 30 or 40 years old, the deficit picture will not change. And both candidates, both Trump and Biden, have basically taken reform off the table. They have both sort of run on the mantle of actually preserving Social Security and Medicare. So again, bottom line, deficits are probably going to be the big loser, at least over the next 5 years or so. And then there will probably be some urgency around reform of Medicare and Social Security, because actually those trust funds are going to start being depleted in the early 2030s.
One place where I think there may be a difference between these two candidates' policies would be energy, because Donald Trump has said he wants more drilling. He really wants to go for more greenhouse gases. Joe Biden clearly has a different policy.
Yeah, drill, baby, drill, yeah, right? Exactly. Now, of course, ironically, in terms of both oil and gas production, we have seen some of the historical highs under President Biden. That's not something that he is touting, because he knows that is not a real winning mantle or winning position with his environmental folks. But if Trump were elected, what we could see is probably what we expect is an undoing of much of what President Biden has done in terms of the drilling on federal lands and what have you. So the prohibitions that Biden has put into place, in some ways, the undoing of what Trump had done, it will be the undoing of what Biden has done. So the pendulum just sort of keeps swinging back and forth. If President Biden wins, though, one thing that will be clear is that the Inflation Reduction Act, which of course has $600 billion in terms of green tax credits and subsidies, will be preserved. There is no way that he will sign anything into law that will dilute that. Now, I think actually importantly, though, David, is that even if Trump is elected, there will be some lip service about rolling back the Inflation Reduction Act. but I actually don't think that will get a vote in Congress, because by that point in time, there'll be lots of projects in Republican districts. I think a lot of Republicans will be loath to undo that. So maybe you'll see sort of some tweaking around the edges, but not a wholesale rollback.
One of the things we've heard a lot about already are tariffs and trade. As former President Trump has been very outspoken about a 10% perhaps tariff around the world, certainly on China going up to 60% or more. Do we expect that there would be a big difference in trade policy between these two people?
Yeah, so of course, both gentlemen have shown that they are both protectionists. Of course, President Biden has kept on the tariffs that President Trump had imposed on China. I do think, though, that there will be some changes, particularly if Trump is elected. What he has already said on the campaign trail is this 10% flat, tariff on all imports. I think there's a real question: does he have the legal or statutory ability to do that? If you actually go back to President Nixon's administration, he did that same thing in 1971. He put an 10% import surcharge on all imports. Now, we'll sort of see what happens. A lot of lip service doesn't necessarily translate into reality, but that is something that President Trump is talking about. And then a 60% tariff on Chinese goods. Now, he does have the authority to do that. He already has used part of the Trade Act, Section 301, back in 2018 to impose tariffs on China. I think he would use that again. So I do think we need to take him both sort of seriously and literally in terms of what he is saying about trade policy. He thinks tariffs are an effective tool. Some of us may disagree with that, but he likely will continue to pull that lever. And of course, President has a lot of unilateral authority to do that.
So you and I have been talking about the elective offices in the presidency and in Congress. What about the Federal Reserve? You might think that's off to the side, actually, this political process. But we get a lot of questions about, is the Fed taking it into account, and does it move them one way or the other this year?
Yeah, and actually, this is probably our number one question from clients, outside of whether Biden and Trump are going to be, there's going to be a rematch. This is our number one question. Will the Fed act in an election year? And particularly as they get closer to the election, or will they try to sort of sway the election one way or the other? Now, if you look at data, the Fed has actually moved in every election cycle since 1980, either in terms of rates or with the balance sheet. And so what we know is actually they are not afraid of either cutting rates or, importantly, raising rates in an election year. Now, as you get closer to the election, the same thing. They still will actually cut or raise rates. And so I think we need to take Chairman Powell at his word that he is data dependent. He really is looking at sort of the health of the economy and inflation in particular, and he will adjust rates accordingly. And kind of politics are really tertiary, I think, in his mind.
One last quick one, I think. You talk to a lot of clients. Do you see places where the Wall Street is mispricing the possible consequences of the election, where people may be underestimating or overestimating the difference?
Yeah, I think that's a good question. I think our foreign clients in particular are a little bit befuddled as to how in this big, diverse, young country that we have two folks who are on the older side and who have sort of been around the block, so to speak. I do think, of course, there is some concern about the posture towards the external world. We're talking a lot about domestic policy here, but in terms of foreign policy, there are some big differences between the two presidents, and I do think some of our foreign clients in particular are concerned just about the general retreating of the United States, maybe under either Biden or Trump, but sort of the retreating and the withdrawing from some of these multilateral organizations and what have you. So I think that's sort of the big difference, sort of the difference in terms of foreign policy. I think a concern for some of our foreign clients.
Libby, always great to have you here. Thank you so much. That's Libby Cantrell of PIMCO. And tomorrow on Wall Street Week at 6 p.m. Eastern Time, we're going to be talking with Richard Haas. He is now with Centerview Partners, former head of the Council on Foreign Relations. We're going to talk to him about the foreign policy differences coming up in this election. And this is Bloomberg.
Let's take a look now at some stocks hitting highs and lows. CSX hitting a 52-week high. The rail freight company is increasing its quarterly dividend to 12 cents a share. Paint company Sherwin-Williams also hitting highs after it raises its quarterly dividend 18%. Now Equinor hitting a 52-week low. The Norwegian energy company shutting its oil refinery in western Norway because a fire broke out in its electric kiosk. It's unclear when production will come back online. Now coming up, the Lambda CEO joins Bloomberg Technology with Caroline Hyde and Ed Ludlow. Up next, stick with us, Big View on Big Tech. Stick with us, this is Bloomberg.
Great questions. From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde at Bloomberg's World Headquarters in New York.
And I'm Ed Ludlow in San Francisco. This is Bloomberg Technology.
Coming up in the next hour, Cisco shares under pressure. That's after delivering a disappointing outlook again, along with plans to cut thousands of jobs. We have the story.
Plus, Coinbase earnings out after the bell, but shares jumped this morning after receiving an upgrade from JP Morgan. Bitcoin holding above $52,000. We'll break down the numbers.
And hedge funds buy into some of the biggest names in tech in the fourth quarter. Amazon, Intel, Nvidia are among some of the favorites. That was revealed in yesterday's 13F filings. I'm going to walk through the winners and the losers. But first, let's check in on a key loser that is a mover on the day. Some breaking news. Temenos, based over in Europe, confident, it says, the company, this is a software technology story in the finance space, says it's confident in the strength of their operations, of their financial cash position as well. This is after a short note was put out on the company. SIX, that's the benchmark manager over in Switzerland, saying that Temenos is suspended from trading until further notice. We'll have more on that story as and when needed. But for the time being, let's get back to the macro picture of what's happening in US trading, aside from what's happening in Europe. We're off by 0.2% on the NASDAQ. Some big tech names just rolling over, coming off our record highs, and we're pulling down. Two-year yield, though, actually managing to dive a little bit. Now, this is as we get that retail data that showed that not everything is quite as rosy in the US economy. Retail sales just falling that little bit lower in January, under what had been anticipated. Maybe the Fed does cut in the second quarter. Yields fall. I'm looking at what's happening in the dollar versus the Japanese yen. Dollar under pressure across the board, all the G10 currencies, but notable even against the yen. Now, this is as we see Japanese economy as a whole fall into a recession, and the yen has been under pressure of late. Let's move on and have a little look at what's happening in the great world of crypto, because we're going to dive so much more into ecosystem, the VC money going into crypto a little bit later in the show. But for now, we're coming off of our highs, but we're still above $52,000 when it comes to the OG that is Bitcoin. Ed, what have you got on the micro?
A lot going on. Let's start with Cisco cutting jobs. Cisco is revising its full year guidance. The story, customers are worried about the economy. They're pulling back on networking spending. We will get more details on that later in the program. I would say Cisco is not down as much as it had been earlier in the session. Alphabet, parent of Google, also interesting. One of the big movers to the downside, The Information is reporting that OpenAI is working on its own search, powered by Bing. Not drawing a direct link, but there seems to be some pressure resulting from that story. Nvidia, one of the interesting stories of the 13F situation, they're putting money into a lot of the ecosystem that their AI accelerators are supporting. We'll dig into that. And finally, Amazon, I put those there because basically when I last checked, Nvidia jumped above Amazon in the ranking of biggest companies by market cap. It's a pretty close run race right now. But when you compare them in terms of revenue, it's just such a fascinating story. And with Nvidia earnings on deck next week, that is certainly one where we have to think about the valuation. DoorDash is the other one after market. The gig economy has been the story of the week. DoorDash reports it's up 1.75%. Does it benefit from the same things that Uber and Lyft told us in the last 7 days or so, Karen?
That's what we've got to focus in on. We've got the perfect guest to really talk us through some of the key earnings still to come and that have been in the past. Of course, Mark Mahaney is joining us on the array that has been tech. Let's just start on Dash. Push us forward. It seems as though the consumer's resilient, and so some of these gig economy companies are resilient.
Caroline, I think that's right. I think your interpretation is correct. That's sort of what we learned from Uber and Lyft. Now, these are all marketplaces, and so you've got to focus on two things, the consumer demand dynamics and also the supply dynamics. But the read-throughs there, I think, were sort of equally positive. Lyft and Uber talked about 25-30% rise in number of drivers on a year-over-year basis, drivers, couriers in the case of Uber Eats, Uber Delivery. So, and that's for a variety of different reasons, but I do think that the services just become better working experiences. There's been a lot of technical improvements in terms of the app for the couriers, for the drivers, and I think the economics have gotten better. There's better pay to be had. So anyway, all of that should come through. We should see it in DoorDash's numbers tonight. Now, this company's going to give forward-year guidance, and companies are usually conservative when they give forward-year guidance, so that could be a risk factor here. But I think the overall macro trend, I think, is positive for DoorDash, and the gig economy trends, I think, are specifically very positive for DoorDash.
Mark, there is one story that everyone has been talking about in the past 24 hours. It is the case of the errant zero. Have a listen to this really quick.
Look at the growth, look at the fundamentals of the financials, and to be very clear, it was a bad error, but it was 1-0 in a press release, and a lot of other pages. And of course, we corrected it within seconds of finding it. So I think, like with any mistake, I think it's not so much about the mistake itself. It's also about how you correct for it. And we've corrected for it, obviously, in the moment, putting out new materials, but also doing a really deep process dive, including having our own internal audit team, a separate team, look and figure out how we can make sure we never make a mistake like this again.
That was David Risher, the Lyft CEO, talking to us yesterday, Mark. Have you ever seen anything like that in your career?
No, I haven't. And I remember, looking at the press release, looking at the 500 bips of guided margin expansion, and then hearing the CFO talk about 50 bips, and I whirled around in my chair and said, wait, there's a problem here. But no, I haven't. But look, it's a mistake, and I think David's comments were right, which is we all make mistakes. That's not terribly interesting. What's interesting is how people react to them and whether they come out flat and admit that they made a mistake and correct it. And I think they did a decent job of doing that. It's unfortunate, but the markets at the end of the day is kind of went through this. I mean, the margins are still improving, and the demand trends are better, and there are focusing on free cash flow. I mean. There's a profitability inflection point here. All of these businesses, if you give them enough scale, you give them enough revenue growth, they'll get the profitability. People were very uncertain about that when the IPOs of Lyft and Uber occurred back in 2019, even more uncertain during COVID, but it's come through. These companies have grown, their bases have built up, their driver supply has improved, their consumer demand has improved, and through all of that, profits are starting to really show up, and investors are reacting very positively to that. They should be.
Shares didn't react positively to Airbnb, Mark. I know you've been looking at that particular company and deciding whether ultimately it should be a long-term bet or not. What do you make of Airbnb, as it does see just a little bit of cooling in demand?
Well, it's the highest multiple stock in travel. It trades like 30 times, 35 times earnings. I do prefer Booking, BKNG, and I do prefer Expedia, EXPE, to Airbnb. Airbnb's results were fine. We thought they were going to have to warn about their March quarter, and they did. But that was because you had a real tough comp. You had a pull forward of demand beginning of 2023 that people just had to remember. And why did you have a pull forward of demand until early 2023? Because everybody wanted to travel, but this was in by Western standards, it was high inflation environments, and so people booked early so that they could avoid price spikes during the summer. Those price spikes, by the way, didn't happen, but people were concerned about it early on in the year, so you had pull forward of demand, created tough comps. But as we go through the year, I think Airbnb's fine. The growth isn't what
Oh, a technical difficulty.
Mark, I think you're back.
And that's the Olympics, and Airbnb will benefit.
Mark, we lost you for a second there, but that gave me a chance to look at my Bloomberg terminal. Alphabet, parent of Google's the biggest points drag on the NASDAQ 100 this morning. The story, the information is reporting is that OpenAI is coming with its own search, partly powered by Bing. The stock seems to be reacting. We're down 3% on the A shares. What do you make of that? Alphabet's a company you cover.
I'd be surprised if OpenAI, with an integrated search engine with Bing, would really take away search share from Google. You'd have to do a lot of things to take away search share from Google. You'd have to come up with a much better search product. You can't just have a Me Too product. So if Google's going to trade off 3%, I'd probably buy the stock just based on that. I think that correction will be corrected. But we'll see. There's more competition, arguably, now for Google Search. I just think Google Search has continued to improve. I think some of these Gemini features that they're rolling out are going to improve Google Search. So I'll take the other side of a 3% correction on market share figures for Google.
Mark, we just have 30 seconds. Of the ginormous universe of tech companies you cover, who won earnings period so far?
Amazon, and especially Meta. Everybody's spending more on Meta today, and margins and profits are rising there dramatically. Meta looks like a really well-positioned company in stock for 24.
All right, Evercore's Mark Mahaney, and as I said, a massive universe of different technology companies covered. That's why I love having you on the show. Thank you very much. Now, coming up on the show, Cisco becomes the latest tech company to undergo layoffs with its own plan to cut thousands of jobs. We're going to take a close look at their guidance for the year. Kara, another stock you're watching?
Well, we go back to where we started with Mark Mahaney, really. DoorDash on the up and up today, 1.7% higher. Will results get a boost from non-restaurants? That is what is being questioned in our own Bloomberg preview today. They're reporting their fourth quarter results after the bell.
after that strong report from rival Uber. Well, many anticipating that they're going to be going well. Marketplace gross order value estimate $17.2 or $17.1 billion. This is Bloomberg Technology.
Cisco's the backbone of the internet, as you know, and their routers, network, server, business, these things, their switches are truly important to bringing in cash flow, but the future is in services.
That was David Barnson, their CIO of the Barnson Group. And the thing is, things didn't really transpire that way. He was speaking 24 hours ago, but last night, Cisco out with some pretty negative news. Cutting headcount by 5%, revising their full-year guidance and saying our customers are worried about the economy, so they're pulling back on spending. And at the same time, that ripple effect from AI, it's just not there for Cisco. I want to bring in Bloomberg's Brody Ford out in New York City. I mean, for me, that was the story. The difference between networking and infrastructure, the hyperscalers data center, Cisco's not quite there yet.
Yeah, I think this is a song we have heard before, that corporate customers are a little worried. You know, Cisco said that they bought all this stuff over the last couple of quarters, right? All of this infrastructure for servers and internet, and they're saying, wait, let me install all this stuff before I buy more, because that looming recession could still be there. So yeah, those corporate IT budgets, as much as people have said that they are coming back, it's clear from Cisco that folks are still a little bit anxious.
And what's interesting is last quarter they missed, stock fell, and Chuck Robbins said, I wish I could blame the macro, but I'm not gonna. Whereas this time he kind of blamed the macro, and he's not blaming a big acquisition that they made.
Yeah, absolutely. $28 billion for Splunk. It is on the way. It has not closed yet. Big companies will often say that mergers don't necessarily cause job reductions. It seems like they usually do, right? I mean, they're about to bring in a couple thousand workers from Splunk. There's going to be overlap there. And I think most people watching this say that this is kind of preempting some of that overlap. We're in an environment where companies want to keep profits as high as they can, keep expenses low. I would expect part of this is due to that Splunk acquisition.
And Splunk have been laying off workers as well in anticipation maybe, or just reacting to how the market is. And just fold in whether if they are blaming macro this time, how much also just people have just sat on a lot of gear and they haven't deployed it yet, ultimately?
Absolutely. Hardware, it takes time to install, right? I mean, there was a period where there's all these backlogs and people couldn't get the things they needed, whether that was in routers or computers. That eased up and people started buying. They said, let me get it while I can, right? And I think now they're sitting on a lot of this stuff and they're not wanting to buy more. At least that's the narrative we heard during the earnings call last night.
The numbers are that they've revised their full-year sales guidance down by around $2 to $3 billion. 5% headcount trim is about 4,000 staff. So it's not severe, but it doesn't inspire confidence. Tell us about the partnership with NVIDIA, because I think there is some optimism from the sell-side analysts this morning that that might plot them a path forward.
Yes, there is some optimism there, but I will also say that if I wanted to count off all the companies I've heard of with partnerships with NVIDIA, I wouldn't have enough fingers, right? I mean, it's hard to tell exactly how much uplift we get here.
Oh, Brody Ford. Keep going, sorry. You're right.
No. Another funny wrinkle here is that in the networking space, Cisco has been unquestioned for a long time. We have another funny merger coming, HPE and Juniper, and they expressly say that we are doing this to take on Cisco. I think that will take, a number of quarters to see whether that really hurts them or not, but I think that is another wrinkle here, that there is a looming competitive concern. So one more thing to consider here. Maybe NVIDIA can't save them.
Oh, NVIDIA not to the rescue this time. It has been to the rescue with certain share prices today of others that we'll dig into in a bit later. Brody Ford.
Thank you.
Always a joy to have on this show. Meanwhile, coming up, AI startup Lambda. It's nabbed a $1.5 billion valuation, its latest funding round. Its CEO is going to be joining us, Stefan Balaban, joining us next, Ed, but you've got something to look ahead to.
Yes, Supermicro. This speaks to every story we've just covered. The stock is now up 236% year to date, 9% in the session. Bank of America initiating coverage with a buy rating, 1,040 price target. This is basically what Cisco is not. It's everything in the data center and the server design apart from the AI accelerator itself. So they're a real beneficiary of the infrastructure build out we're seeing, and they've massively outperformed every index, even NVIDIA, by many factors. And so this is one that we want to talk about more. Supermicro computing up 9%. This is Bloomberg Technology.
Time now for Talking Tech, and first up, a SpaceX rocket has blasted off in the middle of the night, aiming to make the first touchdown of a US-made spacecraft on the moon in 50 years. Called Nova C, the spacecraft built in Houston is based Initiative Machines, the company behind it, and will make its touchdown attempt on February 22nd. Meanwhile, chipmaker Renesas agreed to buy software firm Altium for nearly $6 billion, the biggest acquisition yet for the Australian-listed company by a Japanese buyer. Now, Renesas, which is a Toyota supplier, is looking to lower its reliance on making automotive chips. Plus, Taiwan's stock benchmark surged to its highest level on record, boosted by what? Expectations of strong AI demand. The TAIEX rallied. That's as TSMC, which has a weighting of around 30% of the index, reported its January sales, and they rose almost 8% from a year ago. It really is propelling the chipmaker's market cap to a record $575 billion. It's enough to surpass Visa to become the world's 12th most valuable company. Ed, what have you got on AI?
Okay, Lambda, which provides cloud computing services and computers to train AI software, is announcing a Series C funding round, $320 million, valuing the company at $1.5 billion. The financing was led by billionaire Thomas Tull's U.S. Innovative Technology and includes participation from the likes of B Capital, SK Telecom, as well as Bloomberg Beta, the venture capital arm of Bloomberg, Bloomberg LP, of course, the parent company of Bloomberg Television. Let's bring in Lambda CEO Stephen Balaban to join us for more. Let's go back to basics. What is it that Lambda does? What do you build and what do you offer?
Lambda is an AI compute platform. We have GPU servers, GPU workstations, and a GPU cloud service that we provide to AI developers.
And so this money is a significant Series C. We've done a lot on this show about the build-out on AI infrastructure. We're literally talking server designs going into data centers normally run by the hyperscalers. What are you going to take that cash and do with it?
Well, we're going to be deploying tens of thousands of new NVIDIA GPUs into our data center and providing those GPUs as part of our cloud service.
Okay. Go back to the origin story here, Stephen, because it's an interesting one. You weren't always in this game. In fact, you were making facial recognition technology and ways in which I could augment my face via AI. And then your own bills for your own cloud consumption got too high. So tell us that.
Yeah, so Lambda started off as a face and image recognition software development company. So we were AI engineers ourselves. And we ended up getting a really high cloud service bill, and we figured, you know what, it was a lot more cost effective for us to redesign and reimagine what an AI cloud should look like in the age of training neural networks and inferencing neural networks. And so that's how we pivoted into the cloud business that we're in today.
And Stephen, I really want to try and understand competitors versus frenemies. I find it very hard to basically get to grips with who you're servicing, who your clients are, because it looks as though some of your clients are even some of the hyperscalers that ultimately you're going in competition with. Can you just tell us how ultimately you think the lay of the land will look like in 5 years' time?
Yeah, so Lambda's customers include, trillion-dollar market cap Fortune 500 companies, companies that are major enterprises like Rakuten who are integrating AI into their products and services, and venture-backed startup companies like Anyscale. And so, we really primarily provide and cater towards that AI developer, and that's who we've been basically providing our services to.
Steve, I'm just really interested on the hardware side of this story. So, I'm assuming that you guys are building out your infrastructure with DGX or HGX, right? The broader server design. But what's happening right now in 2024 remarkably quickly is we're kind of moving from this focus on training to inference and understanding the energy and compute load for inference. Do you then start looking elsewhere at like AMD, their MI300X? How do you transition your own footprint in business?
So, look, today Lambda is exclusively providing NVIDIA GPUs. And the reason for that is because that's what the market's demanding, right? It's very simple. We are a compute provider that, technically speaking, and from our software architecture and our software platform, is agnostic to what the underlying accelerator platform is. But so far today, we've been pure NVIDIA.
let's look at the valuation and let's look at the money you raised. Valuation is high. Talk to me about the reality of your business from a revenue generation standpoint, which markets you operate in outside of North America, the number of customers you have. I think we're learning about you and we're thinking, well, hold on, this sounds like you're a really key part of the system.
So Lambda's been pretty under the radar, but we have over 10,000 customers. In fiscal year 2022, we did over $100 million of shipped GAAP revenue. Last year, we did over $237 million of shipped revenue. So we already have a pretty substantial business. And in terms of valuation, I think that you're looking at these revenue multiples and you're probably thinking, wow, that's actually quite reasonable given the growth, given the customer base, and given the just sheer amount of revenue we have.
Lambda CEO, Stephen Balaban, thank you so much for your time on the talks of the fundraise, what you're going to be deploying it on. Meanwhile, we're going to be talking a lot more about not AI, but the previous hype cycle, crypto, blockchain, Bitcoin, the ETFs, and so much more. Robert Lay is going to be with us, crypto analyst at PitchBook, out today with a brand new crypto report. That's next. Meanwhile, we're just going to focus in on those Swiss shares again of Temenos. Now, this is a software solutions company in Switzerland, had market cap well above the 4.7 billion we're currently seeing. This is currently off by 30%. It's a Hindenburg short note, and they are refuting it. That's more. They are down the most in 21 years. But overall, Temenos says it is fundamentally refuting the report published by Hindenburg Research and saying that there are misleading and false allegations. This is Bloomberg Technology. Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco. I want to focus in on crypto for a minute, and in particular Bitcoin. What else? We're above 52,000 US dollars per token. There is some momentum here from the Lunar New Year. There is a concentration on the data around net flows into the spot ETFs that are available. And as we discussed on this show, some people are thinking about the imminent halving that's coming in April. But this is the highest level since December of 2021. We've been at that level for a few days now. Kind of interesting. That is on the pure risk asset that is Bitcoin. On the equity side and crypto-related stocks, we're zeroed in on Coinbase, partly because Coinbase reports after market, and I think there's an expectation here that Wall Street might get surprised with profit in Coinbase's case. I always look at the chart, and there is quite clearly a close correlation at the moment between the trading we see in Coinbase, the movement that we see in Bitcoin. But JP Morgan, one of the more bearish names on Coinbase, ditched a very short-lived call that they had on the stock earlier. I want to go to DC and bring in Bloomberg's Kaylee Lyons. I mean, that for me is a lot of different stories, but Coinbase really in focus today.
Yeah, absolutely. To your point about how short-lived this JP Morgan bearish call was, the call was just made on January 23rd, essentially saying that Coinbase was going to suffer because enthusiasm around these spot Bitcoin ETFs was going to deflate, and that would lead to lower volumes, therefore lower revenue potentially for Coinbase. What we have seen, though, and you were just speaking of it, is instead a rally in not just Bitcoin, but Ethereum as well. Bitcoin's above $52,000. And so today, JP Morgan is actually saying that as you have these higher prices, that is going to translate into better business for Coinbase as an exchange, because the higher volumes you have, obviously more activity and higher value when you're deriving a fee based on value, all of that could add up to a more positive earnings picture for the company. And of course, we're going to get detail into what exactly that earnings picture really looks like after the bell today. As you said, most analysts do still expect Coinbase is going to post a loss. The average analyst estimate is a loss of about $16 million or so. But there are some who actually think we could see a surprise profit, including Oppenheimer and Needham, which is looking for net income of about $103 million. So we'll see if we are indeed surprised come a few hours from now.
Bloomberg's Kaylee Lyons, one of the hosts of Bloomberg Crypto, which honestly is a show that you really need to be plugged into right now. Great to catch up for you out of DC. Kara, what do you got?
More on crypto. SEC Chair Gary Gensler, he sat down with our own David Weston to explain his reasoning behind all of those approvals of those Bitcoin ETFs, spot Bitcoin ones. Take a listen.
Several years ago, back in 2021, there was a product that went live, so to speak. An exchange-traded fund wrapped around these Bitcoin futures at the Chicago Mercantile Exchange. And then a different set of products came to us and asked to list on the stock exchanges. And while we had denied like 24 of these over about 5 years, a court in Washington said no. They thought we had not gotten that right, and they remanded it back to us. And I thought really the most sustainable thing forward was to approve these given the court ruling. In terms of the statistics, we really do look out to ensure as best we can there's not fraud and manipulation. But one of the challenges on the Bitcoin markets, David, is so much of it's traded on trading platforms that are non-compliant with our laws. Now, Bitcoin's not a security, but they're trading on those platforms a lot of other crypto tokens without prejudging any